JEPI, you've probably seen that ticker thrown around a lot, and it represents the JP Morgan Equity Premium Income ETF. We're going to talk about why JEPI is so popular, how they can achieve their high yields. We're going to touch on covered call strategies, killing two birds with one stone, and then we're going to point out some very obvious problems with JEPI. Now, whenever I see this quote, I think of one of the only culinary creations that England should be proud of, and that's their Branston and white cheddar sandwich. And the quote is, "There's no such thing as a free lunch." I think this is probably one of the most important lessons that every young person eventually learns, from dating to job seeking to investing. There really is no such thing as a free lunch, and you start to get very suspicious when you see investment products that propose something different. Now, the JP Morgan Equity Premium Income ETF was launched in May of 2020, so there's very limited performance data available. Now, performance comparisons aren't overly useful anyways, unless you're going back a decade or more, but it's more important to understand the mechanics of something you're investing in. And when you do understand the mechanics of JEPI, it's very easy to see what game's being played here. So this was taken from an article by Verify, a very good source of information for ETFs. It talks about how writing call options should provide JEPI with additional income, which means that it will miss out on the full gains from increases in the underlying portfolio. So it's not good to hold an asset that does poorly when the market is going up, because that's what the market has been doing since inception. This magic number, 6.6%. Remember that. That's the inflation-adjusted return of the stock market since existence. So this article goes on to say that this is an actively managed fund, and really you're betting on the manager's ability to outperform the market. Well, we know that they can't with their strategy, but let's say to provide superior risk-adjusted performance. Well, 95% of active managers can't beat a benchmark, so you better hope they're in the 5%. Goes on to say JEPI offers a hedge fund-like strategy in an ETF wrapper. Well, you always invest in what you know, and you shouldn't invest in black boxes unless it's a hedge fund like Citadel or Renaissance, if you're lucky enough to have enough money and the right contacts to actually invest with those types of firms. Now, these managers of JEPI, they don't have to outperform. They're already winning, so you can do the math here. This is an actively managed fund versus a rules-based index like SCHD. So two fundamentally different investment products. The managers of JEPI are printing money. So the $32 billion in assets under management, that's a very large number in respect to ETFs attracting assets. You multiply that by their low expense ratio, that's quite low for an active fund, of 0.35% or 35 basis points. You get $112 million. Well, that's enough to pay the two or three gentlemen that are managing this strategy and have a plenty of left over for the firm. But that lower expense ratio also masks other costs. For example, they have massive turnover. So if you have a turnover ratio of 100%, that means that your ETF or fund has bought and sold all its positions within the last year. They've almost done that twice at a massive turnover number. They're 190%. There's tax implications associated with doing that. It's why you're penalized by the tax man for short-term capital gains. There's transaction costs, of course, and there's structuring costs for all the equity-linked notes in this strategy. And you may have not heard this acronym, ELN. We're going to talk about that. So when you look at what they're investing in, 80% is U.S. large-cap stocks selected using a proprietary methodology, and then 20% of that exposure is to ELNs. But when you look at the return profile for their income, those numbers flip. So, of course, someone has to sell these equity-linked notes on the other side of that transaction, and that's what their sales and trading desks do. Why is JEPI so popular? Well, it seems to be the ticker du jour for YouTube financial gurus. I think most of the people throwing it around don't even know what it is. What investors are drawn to immediately is the high yield, and I think the word premium is really misunderstood here. Short-term performance, as I said, is relatively useless, and honestly, comparing SCHD to JEPI is really apples to oranges. Now, we've already looked extensively at what SCHD does, and you can see just some of the videos that we've put out here on that topic. So I'll assume you're coming to the table with an understanding of the mechanics of that ETF. Today we want to focus on JEPI. So to understand how they generate all that income, we need to understand an option strategy called covered calls. Now, the ability to participate in this strategy is a function of your bankroll size. And I put this table here on the right, which shows what it takes to have 100 shares in a handful of companies here. So you can see that for Coca-Cola, because it has a low share price, that's a fairly small amount, right? $6,000. But then when you consider like a Caterpillar, that goes to $32,000 because the share price is a lot more. This matters because in order to sell a covered call, you need to hold at least 100 shares. So they do round lots, increment of 100. So if you have 200 shares of Coca-Cola, then you could sell 2 contracts. Now, larger institutional investors don't have this problem. First of all, they deal with a lot more money, and that would decrease their transaction costs, presumably. But they also have a much larger universe to maximize their alpha from. And then when you look at this table here, I've also put on the right the minimum portfolio size that you would need to have, let's say, a 5% position in these various companies. So the more bankroll you have, the more alternatives you have for selling covered calls, but we would suggest, based on what we're going to talk about today, that's not a good idea. Now, if you don't know what a covered call is, it's very simply you're capping your upside return for a given duration in exchange for a small amount of money. So if this option product isn't completely intuitive, then you shouldn't get involved in this at all. Now, the less likely it is your return gets capped, the less money you receive. So there's an incentive there to take risk for what investors perceive as income, but it's not actually income. It's simply a play on risk and volatility. Now, covered call strategies. Remember that when you sell a covered call, if that triggers, then your stock gets sold if you don't buy the option back, and there's a tax liability there. So you need to monitor your strategy and buy that option back if you need to, so you don't have to pay taxes or prematurely exit one of your positions that you're presumably holding for the very long term. Now, the further out of the money that you are, the less likely you get called, the less income you receive. So there's always a temptation to boost your income in exchange for a higher likelihood of having those shares called. Now, transaction fees are going to erode your returns, and what you need to do is have a rules-based system that you've developed, not sold to you by some monkey. Intuitively, a covered call strategy does not outperform the market, though there are ways to create better strategies. We'll talk about that a little later. Now, here's a great example of why writing calls doesn't outperform. It looks at it's called the buy-write index. It looks at the annual returns of the S&P 500 against a call writing strategy. So this is like our previous example of a call option, except it shows the underlying security for that option as the S&P 500 index, and it shows that the annual returns over 27 years with and without covered calls have largely been in favor of the S&P 500, though in times of high volatility and market downturns, you can see some outperformance from the buy-write index. But it's intuitive then that a call writing strategy is not going to outperform. Now, the other thing to note about options and covered calls in particular is that when volatility goes up, you're going to get more when you're selling calls. That's because risk has gone up, and volatility equals risk. So when I did my master's in finance, we had to sit down and manually calculate prices of different types of options. I absolutely hated it. But the other thing to note here is that the popularity of these strategies since 2004 has created another problem that's covered in this paper, a devil's bargain when generating income undermines investment returns. Relatively recent paper. The gentleman there highlighted, I won't butcher his name, is a quant over at Citadel, and he wrote this piece about how the popularity of the yield-enhancing strategies such as JEPI has led to overcrowding, which results in shrinking premiums. So again, there's no such thing as a free lunch, and this undervaluation of call options now is a curse of popularity. So the takeaways here, implementing a covered call strategy as a retail investor can be capital intensive and time consuming. It can be difficult for stocks that trade at high prices. So if you choose to do that, you need to manage your covered call strategy very closely, and of course take into account the mathematical variables in the Black-Scholes pricing model that influence options pricing. I don't think a lot of retail investors are able to do that, or if they're willing to put in the time it takes to properly do that. Now, investors, of course, can get affordable, transparent, and liquid exposure to covered call strategies by investing in ETFs such as JEPI. Now, people will say, well, when it comes to writing covered calls, I'll just write them far out of the money in hopes of not being called. Well, yes, Nostradamus, we know you're the exception. You're able to figure out those particular plays are going to generate alpha, but for the rest of us commoners, the reality is this, that sitting in your underwear running some Excel spreadsheet calculations on a Saturday afternoon isn't a match for hedge fund algorithms, and you're not going to consistently beat the market over the long term. People that assume they can, this is the sort of unconscious incompetence that you often see exhibited by newbies. So anyone suggesting that you should engage in options trading, they don't have your best interests in mind. So let's get back to JEPI. This diagram here shows where all that yield is coming from. Let's say 80% of that yield is coming from options premium of the type that we've discussed, but not just the JEPI managers logging into their Robinhood accounts and buying some options. They're doing things at an institutional level. And the first thing to note is that when you look at yield, you're going to see conflicting numbers. Make sure that you calculate it or you understand the underlying data so that you're correctly calculating it. You can see here, taken from Yahoo, the data that they're using is actually, we validated that against NASDAQ, and there's two ways to look at this. You can either calculate the yield based on the last payment, which is what JP Morgan has done here with their 6.86% number, or you can do that based on the last 12 payments, which is what the Yahoo calculation is doing. You see here we've pulled the data from JEPI and then from NASDAQ. So NASDAQ is a decent source of data. We use that for our own dividend growth investing strategy, Quantigens. The variable that to pay attention to here is the variability in the payments that you can see, right? They're not very predictable. Now, net return, which is the return of this asset minus dividends, doesn't take care of itself as it does in DGI strategies. So the longer you hold JEPI, the more likely it is you're going to underperform the market. And you can see this is their yield calculated over time and through a rolling window. And because those dividend payments fluctuate over time, the amount of income that you receive is going to as well. And the very nature of this entire ETF is that it won't outperform, and the managers are pretty much telling you that. So on the tin, they talk about this combination of selling options and investing in U.S. large cap stocks. So what they end up with is a low volatility equities portfolio that utilizes their proprietary research process, and that a significant portion of their returns associated with the S&P 500 index will be given to investors. Notice they don't say that they plan to match the S&P returns or even exceed them. They just hope to provide a significant portion with monthly income. This is a classic example of instant gratification versus delayed gratification. And when you dig deeper, they talk about how the fund may invest up to 20% of its assets in equity-linked notes. These may be more costly, and of course they are, though JP Morgan has an advantage because they're probably their structuring desk is putting together and their sales and trading team is selling them to institutions, so to take the other side of that trade. So there's no liquidity for these assets. That's a big red flag. There's liquidity risk, and they're also subject to certain debt securities risks such as credit or counterparty risk. That's a really big deal, and anybody that's worked in finance or is experienced by now understands what's going on here and sees these red flags. We've heard this story before and seen it a million times. The retail investor out there who's seeing this ticker thrown around isn't really understanding what they're getting themselves into, and you can see that from some of the meme stonk elements. These are some comments I pulled out there from people talking about those who dare criticize their sacred cow. Message received, doubling my JEPI position. Classic response from somebody who doesn't actually engage with facts. Another one that doesn't like income. Only owning 80% in actively managed stocks coupled with 20% for derivatives seems to work. Yeah, it seems to work for now, of course. JEPI managers are the only ones that are winning, and they're the firm that they work for. And this one individual says it correctly, that historically opacity favors the seller money managers and disadvantages the individual investor. Absolutely. People say, well, it's not supposed to outperform, then why would you hold it? What JEPI does, it provides instant gratification, 75 cents today instead of $1 tomorrow. So this is what happens when you have mostly amateur hour analysts out there guiding retail investors. Now, if you want to get involved in covered calls, then here's some homework for you. Read this paper, again, by that Citadel quant, Ronnie. It says Covered Calls Uncovered. And if you're able to understand the takeaways in this research piece, then you're probably ready to start executing your own covered call strategy. And what they look at here is the ability to hedge away risk that you're not being compensated for. And you can see that refers to equity timing risk. So it's very interesting to see how complex these strategies actually are. And as I said, if you think as a retail investor that you're going to be generating alpha using them, then you better put in the time to really understand what you're doing. As we said earlier, there's no free lunch. So we had a lump sum question from a premium subscriber. He says, I have $1 million. Why not get all that income now? And it's simply because of total return. You can have instant gratification or delayed gratification. The longer that you hold JEPI, the more likely it is that your total return is going to be less than if you just put that money into the S&P 500, because the very nature of this strategy goes against the nature of the stock market. People will say, I'll just invest in JEPI during a bear market. Okay, Nostradamus, well, let us know when that is so we can all benefit from your insights. Stop dicking around and jumping in and out of ETFs because you need somewhere to put your money. Figure out a strategy and start investing in it. And when it comes to SCHD and JEPI, these are really apples and oranges. People say, well, I'll hold SCHD and JEPI. Well, that's like saying, I'll hold asset A along with another asset that has capped returns. Well, why don't you just hold assets that don't have capped returns? You might make a correlation argument there, but you can't do that until you have enough data to look at correlation. So again, there's a data problem when it comes to being able to look at performance or correlation for JEPI. Now, I'm going to put up another video here that details why we think SCHD is such a good ETF to invest in. Before you click that, please subscribe to this channel, support our work. Thanks so much for taking the time to watch this today.